Hey guys, it's Hannah and this is the weekly market wrap-up. Now there is no denying that this week was a tough one. Let's get started in the U.S. equities and find out exactly what happened. The U.S. stock market posted its worst one-day loss of the year so far. The Dow Jones dropping over 350 points. Taking a look at the S&P 500 and the NASDAQ, the two lost an average of 2.39% against the prior session. Now, it is clear that market participants reacted adversely to Fed Chairman Ben Bernanke's statements on Wednesday, where he suggested a possible end to quantitative easing by 2014. But important to note that the actual wording of the speech did not change much from prior statements released by the Fed.
If the incoming data support the view that the economy is able to sustain a reasonable cruising speed, we will ease the pressure on the accelerator by gradually reducing the pace of purchases. However, any need to consider applying the brakes by raising short-term rates is still far in the future.
Now, there are two things that we need to watch for within U.S. equities. We mentioned last week that 10-year yields were on the rise and could imply volatility risks in the markets. While during Bernanke's speech on Wednesday, yields rose sharply, and on Thursday, they only continued to rise. When we're talking about yields, the enormous danger to equity bulls is that they are moving higher even despite official rate tightening, clear evidence of economic growth, or real inflation. Looking at the technical chart for the S&P 500, this is the first time that the index has decisively closed down below its 50-day moving average. And with today's close placing the index 0.75% below the key 1600 threshold, this suggests that we can further expect near-term volatility. Moving over to currencies. The U.S. dollar index shot up as expected. It was flirting with the 82 throughout intraday trading, but eventually settled down to 81.80. While this represented a 1.6% lift from last week's intraday low, it did have a strong impact on the U.S. dollar-Japanese yen pair, which closed up 1% against the prior session. To get technical, we can see that the momentum for the dollar has reversed and is setting its sights towards 82.50, where the 50-day moving average is likely to offer some form of resistance. Given that fund managers are advising their clients to keep close to cash, the dollar bounce could be in effect for quite some time. Moving over to the euro currency index, which failed at 134 and was chopped down closing at 132.21 on Thursday, a higher dollar valuation could turn out to be a benefit to Europe's exporting machinery, as well as increasing tourism dollars as lower euro valuations bring down the cost of goods. Moving over to winners and losers. Finding a winner this week was almost as tough as staying positive during this week's huge sell-off, but we managed to find a few unscathed. This week's winner is EDZ, who is up 13% against the prior session. And although it is not the largest percentage gainer for the week, we selected this ETF due to the reversal of sentiment that Western investors have towards the emerging markets. How countries like Brazil, China, Russia, and India, the GDP growth has been phenomenal these past years, but recently, these markets have hit a plateau, and worrying fundamentals have seen an outflow of investor capital. Brazil is especially in the spotlight as it is currently hosting the Confederations Cup, which is the warm-up tournament ahead of the World Cup. The mass protests that have erupted in the streets of Sao Paulo over the transportation price hikes causes us to urge investors caution regarding these emerging markets. Moving over to losers, or more suiting the loser of the week. Ben Bernanke must be named as the loser of this week, as Thursday marked the worst day of the year for the stock market. Helicopter Ben was already called out earlier this week by President Obama when he gave a backhanded comment of how Mr. Bernanke has stayed in his post for far too long. Bernanke presumably did not want to give a firm speech and instead played it safe in order to protect his legacy. However, his lack of confidence and direction sent markets tumbling everywhere and induced bond market volatility. Now, he may be forced to give a stronger speech as a reaction to poor investment dynamics, as opposed to delivering strength under his own terms. Last but not least, let's move over to precious metals. Gold closed down to $1,277 per troy ounce, a devastating blow to the precious metals complex, with the yellow metal now trading 24% year to date. With gold down 29% against its October 2012 high of 1,800, gold is officially in a bear market, unless the bulls can recover immediately from this catastrophic loss. Silver closed down to $19.57, a level not seen since September of 2010. The market is even more bearish for silver as it closed down 37% year to date and is down 44% from its October 2012 high. It was pretty consistent over all of the precious metals as palladium experienced a large drop as well. The current spot price is $666, now putting it below its 50 and 200-day moving averages. The one key difference, though, when analyzing the relative strength indicator for palladium as opposed to gold and silver, is that palladium is a strong asset looking weaker, whereas the other metals have been a weak asset looking even weaker. And that wraps it up. I know it's been a tough week, guys, but hopefully next week the mood will have changed. To make sure you don't miss any of our wrap-ups, hit the subscribe button and like us on Facebook and follow us on Twitter. For VNN, I'm Hannah Bernard.